They told you the game was fair. They gave you a board, handed out the pieces, smiled, and said, anyone can win. What they forgot to mention is that some of the pieces were built to break. I am Mr. B. This is Broke by Design. And today we're looking at something almost too simple to believe. Being poor costs more than being rich. Let's open the file bag. Two people, same city, same week, same basic needs, food, rent, a small emergency. But their costs completely different. Person A drives to the bulk store, buys a month of groceries in one trip, pays with a rewards card, earns points. Their account never dips, so no fees. Their credit score is strong, so their insurance is cheaper. Their landlord offered them a lower deposit. Everything in their financial life is just a little bit easier, a little bit cheaper. Person B lives 4 blocks from a corner shop, no car. The bulk store is 40 minutes by bus. They buy what they need today because they can't afford to buy a month at once. They pay with a prepaid card. It charges a fee every time they swipe. Last month, their account ran short by $12. The bank charged them $35. Their credit score is thin, so their insurance costs more. Their landlord wanted 3 months up front. Same city, same week, same needs, wildly different costs. Here is the question this channel exists to ask. Why does being poor cost more than being rich? And who decided that was okay? This didn't happen by accident. For most of the 20th century, mainstream banks avoided low-income neighborhoods entirely. They called it risk management. The formal term was redlining. The areas they avoided were almost always black, immigrant, or working class. The result was simple. Entire communities had no access to the formal banking system. Into that gap walked a different industry: check cashers, pawn shops, payday lenders. They went exactly where banks wouldn't, and they charged accordingly. By the early 2000s, payday lending alone was a multi-billion-dollar industry, not despite poverty, because of it. So how does it actually work? Here are the 4 main mechanisms. First, the price premium. Buying in bulk is cheaper per unit. Everyone knows that. But bulk buying requires upfront cash and storage space. If you don't have either, you pay more per item, every time. Economists have documented this for decades. Second, the banking fee trap. Overdraft fees, minimum balance requirements, monthly charges. These policies hit hardest on the people who least afford them. A $35 fee on a $12 shortfall is a 291% interest rate. The people most likely to face it are the people least able to absorb it. Third, the credit score spiral. Your credit score was designed to measure financial reliability. In practice, it encodes existing inequality. No credit history, common if you've relied on cash, reads as bad credit. Bad credit means higher loan rates, higher insurance premiums, and sometimes a higher rental deposit. You pay more to access the same things because a number decided you were a risk. Fourth, the transport cost. Access to cheaper goods and better jobs often requires a car or reliable transit. Without one, you pay the geographic premium, the corner shop markup, the missed opportunity, the appointment that needed 3 buses and a day off work. Every one of those mechanisms has a beneficiary. Overdraft fees generated over $7 billion in U.S. bank revenue in a single recent year. Payday lenders charge annualized interest rates that exceed 300% in many states. The rent-to-own industry charges up to 3 times the retail price of goods, paid in small weekly amounts designed to feel manageable. These are not fringe businesses. They are industries, lobbied for, legally protected, built to extract the maximum possible from people who have no alternative. The system is not broken. It is working exactly as designed. Let's make this concrete. A woman works 2 part-time jobs, no benefits, no paid leave. She earns just enough to miss certain assistance, but not enough to have any cushion. Every month is a calculation. Which bill gets paid in full, which gets the minimum, which gets deferred. She has no bank account. A previous overdraft was sent to collections. She's now on a banking blacklist, so she cashes her paycheck at a check casher. They take a percentage. She loads the rest onto a prepaid card. The card charges a fee every time she uses it. She needs a car to reach her second job. The only loan she qualifies for carries 24% interest. She takes it because the alternative is losing the job. Her insurance costs more than her neighbor's. Identical driving record, different credit score. She is not making bad decisions. She is making the only decisions available to her. Each one slightly more expensive than it would be if she just had a little more to begin with. This is the design, not a flaw, not an oversight, a structure that extracts more from people who have less, consistently, legally, at scale. Here is what knowing this changes. When you understand that the poverty premium is a feature, not a bug, it reframes everything. The person who couldn't save wasn't undisciplined. They were operating in a system designed to extract savings at the source. The family that couldn't get ahead wasn't lazy. The slope was built against them. That reframe matters, not because it removes the hardship, but because it correctly identifies where the problem lives, and problems correctly identified can be correctly addressed. Some of that addressing is personal. A credit union instead of a payday lender, a secured card to start building credit history, a community bulk buying group. These are not solutions to a systemic problem. They are survival tools inside one. Know the difference. The larger addressing is collective. The poverty premium exists because it is permitted to exist. That permission can be revoked. Where it has been, where overdraft fees are capped, where payday lending is regulated, the premium shrinks. You didn't design this system, but understanding how it works is the first step toward refusing to let it run quietly on you. The bag was always empty. Now you know who emptied it and why. So, the cost of being poor is more fees, more interest, more per unit, more upfront, more of everything for less of everything in return. Designed that way, maintained that way, profited from enthusiastically that way. The lens is cracked, but the view has never been clearer. If this is useful, subscribe for more. It is free, which, as you now know, makes it very unusual. I am Mr. B. See you in the next one.